Half an hour away from the open in Hong Kong. One more day till mainland markets reopen. You're watching The China Show. I'm Yvonne with David Ingles.
Good morning. Let's get to your top stories today. Stocks across the Asia Pacific rise after a blowout U.S. jobs report sparks hope of a soft economic landing. Now, bond traders are reversing course and bets for another half-point Fed rate cuts. Now, ahead of the mainland reopen, of course, on Tuesday, the rally is drawing some skeptics, even as the anticipation builds, of course, ahead of those opening bells. Investors are also awaiting a briefing by China's top economic planner. And we're live in Taipei as Hon Hai reports faster revenue growth as AI server demand offsets weak smartphone sales.
Happy Monday, and certainly a lot to digest over the weekend, just given, as Dave mentioned, that blowout U.S. jobs report. Does it shift the odds of a 50 basis point cut now from the Fed in November? Is that out of the question now, is what we're asking here this morning? Nevertheless, that is certainly helping the equity market, given the sentiment boost that perhaps we're talking now about a no landing scenario in the U.S. versus a softer hard landing. And you're really seeing that when it comes to dollar yen. Take a look at that boost in the dollar post U.S. jobs. We're talking 148 levels for dollar yen right now. That's helping the Nikkei 225, seeing an upsurge about 2% here. Taiwan's coming online. We'll watch those Hon Hai numbers, as Dave mentioned. Those numbers looking pretty good, thanks to, of course, demand for data centers and the like, and servers, I should say. We're up 1% for Taipei. But look at the treasury markets, right? So we continue to see yields ticking higher in the Asia session after we did see that surge, right? So we're talking about that 2-year yield. The 10-year yield is pretty much a whisper away from approaching 4%. Same goes for the 2-year, and that would be the first time since August that we've seen actually that 10-year at that level. So it goes to show, is this the beginning of this massive reversal in this bond market frenzy here? And it really has upended that whole curve steepening sort of trade here, with that 2-year yield jumping some 36 basis points last week, which was the most since 2022. Swaps now, as Dave mentioned, it's only about 24 basis points of easing for November. So we're not even talking about a quarter-point cut now is needed, or at least is being priced in after that jobs report. Does one macro data change the whole viewpoint is one question. We're watching EMFX. Given the boost in the dollar, we might see bonds as well as FX here in this part of the world falter a little bit. And there you go. You're seeing that being felt the most in Malaysia. Look at the ringgit. We're weakening some 1%. Slight moves in the Thai baht. Taiwan dollar, there you go, also weakening quite a bit. But the won is doing a little bit better than the rest of the pack here today. And of course, it's one day before China reopens, and we've been waiting for this, just given the surge that we saw in 8 shares. HSI had the best week, 3 weeks, I should say, in about 50 years. I think best 2 weeks for the 8 shares since 2007. So there's a lot to catch up on. And then we get news of an NDRC briefing tomorrow. What will they announce? That's going to be certainly the key test of whether this rally can continue, Dave.
Goodness. I mean, the answer looks to be in the early goings an absolute yes in all caps right now. 3.5% out of the gates in futures right now. And we're coming off, again, as Yvonne is pointing out, another historic rally, 35% on the benchmark. CCTV reporting that some of these exchanges, and as we go into the agenda today, will be running tests ahead of that reopen so that massive inflow of turnover and volume does not inundate the system. Goldman Sachs just came out and they upgraded China to overweight. 12 to 15%, I believe, is what they think, where they think the index goes from here. So people are piling into this momentum trade, and lots of things to watch, everything from funding costs coming under pressure because of this demand for Hong Kong dollars, for example. EV stocks on the back of news coming out of Europe, of course, but it's really all about this bull market, which is, by all indications at this point in time, set to continue this Monday and Tuesday, of course.
Yep, so we'll watch that very closely. And of course, we're still kind of dealing with what's been going on in this bond market. Let's bring in our MLI strategist, Mark Cranfield, joining us live from Singapore. Mark, good morning to you. So what do you see are the risks now on that Treasury curve if we see a no landing scenario?
Yeah, good morning. Well, traders are really questioning whether or not that 50 basis points rate cut that we saw in September, whether it was even justified at all, really. So that's the problem. When you have a jobs report as strong as it is, the employment rate down to 4.1, when we were up at 4.3 not too long ago. So people are saying, have the Fed done too much too early? And now we're in a situation where we could get to November, and it could be a coin toss as to whether the Fed even cuts at all in November. The pricing now is well below 50-50 in terms of the market is not fully expecting even a 25 basis points rate cut in November. And the more that we see yields back up the way they have started again this morning, by the end of this week, if we get a CPI report which is at least in line, maybe even a little bit stronger than expected, by the end of this week, people may have priced out even a rate cut for November at all, which is an amazing change when you consider that it was just a few days ago we still thought November could deliver another 50 basis points as well. So that is completely turning the Treasury market on its head. And we're, as you mentioned about the curve situation, we're almost back to flat again in the Treasury curve. And it is quite conceivable that we will go inverted. Again, all that time it took us to come out of the inversion, we may well go back to an inversion before the end of the month anyway, because people will think that the Fed has to reconsider all its options between not just for the end of this year, but into next year as well. So you've got a stock market which is telling you that America is in great shape. The jobs report is very strong. And here we have a Fed who've committed to lowering interest rates, but now must be really thinking to themselves, have they committed too much and may need to dial back on all of that?
Mark, will any of that have an impact on this massive momentum trade that is China?
Not especially when you see that the timing of announcing an NDRC press briefing for tomorrow, just after the markets closes. No wonder we're seeing such a strong start for the futures market for the Chinese stocks. That is a clear message. They saw the success of the PBOC briefing a few weeks ago. That kick-started this massive rally in all things China. They've seen how successful that is. They want to keep the momentum going, so they're holding their own briefing just after the markets reopen tomorrow. That is surely an indication that they're going to keep on pushing the message that they're on top of this, that there is more stimulus to come. They're going to keep on going until they're quite sure that everything is on a stable footing. They want to see recovery in equity market. They also want to see recovery in the economy. That's very important as well. They're going to keep on driving that until people really believe this is the turning point. This is the watershed. The Chinese economy is going to get better from here. So it wouldn't be surprising if not just the NDRC, but as the days go ahead, we see more people from the Chinese, from the fiscal side, from the monetary side, people drumming in this message that they're all working together, they're all going in the same direction, they want to see a recovery. There is no turning back from this.
Mark. Thank you, Mark Ranfield, there, setting us up perfectly for this week as well. In terms of what else to watch out for, there's plenty of central bank meetings as well. You're going to get those FOMC minutes on Wednesday, but really here in Asia, you have India, New Zealand, South Korea, and possibly even Singapore, who might actually be doing something when it comes to their central bank policy here. We're expecting maybe even a 50 basis point cut from the RBNZ this week as well. BOK might be a little bit more gentle in their easing cycle, and they might start with a 25 basis point cut there as well. But certainly one to watch is also that inflation print out of the U.S. Now that we have such a big number when it comes to that job support, this is going to be the next milestone for the bond market for sure, Dave. Absolutely. In fact, this time, the next hour of the China Show, Johanna Chua out of Citigroup, she's head, of course, of heads of emerging market economics, will be joining us. So they think now 50 is off the table, it's 25. And they also have some calls here as it pertains to many of these central bank decisions this week in the region. Also counting down to the open of trade here in Hong Kong. And again, this Monday morning, a fourth or even fifth straight week, futures are punching through the ceiling. We're up 3.3% in the early goings on A50 futures here in Hong Kong. This is the China Show. All right, good morning. Good Monday morning. Welcome back. You're watching the China Show. The bulls are out early this Monday morning, as you can see. Keep in mind, mainland markets remain shut for a final day before things reopen tomorrow. All that being said, the news flow out in the weekend. Perhaps front and center is this NDRC briefing that was announced to take place around this time tomorrow.
pushing prices up even further. As you can see, we're up 2.5% on futures, so we are poised to extend this rally, as Yvonne is pointing out. The best 3-week stretch on the Hang Seng Index going back to 1975. Goldman Sachs out with their latest call, upgrading China to overweight. How much further can this rally go? Jonathan Pines is here with us on set, portfolio manager at Federated Hermes, usually based out of London.
Correct.
Graces us with his presence this morning. Your fund is mostly an Asia ex-Japan. A lot of that is China, so congratulations, by the way, on that call. When do we start asking questions around this rally, or is it too early in this sort of reset process?
Well, we got overweight China too early. And the levels was much higher than it was now. So if you look at the level of the China index, it's below what it was 10 years ago, the 8-share index, for example. And we think valuations are very supportive. Now, of course, when you get a 30% rally in such a short period of time, it's right to question whether you're going to see short-term pullbacks. But we think that China still offers among the best opportunities in the world from a valuation point of view, and certainly in Asia.
And even after this rally, you still think valuations are still cheap?
Yes, we do actually.
Yeah.
It's still trading at low valuations relative to its history. Of course, in the short term, it's very difficult to call. But we are significantly overweight China, and we expect to remain so.
The news flow that we've heard so far, some of the pronouncements have been, I think there was a very low bar to impress funds like yourself that have been long China anyway because of valuations, domestic investors. How much more do you think, though, the other pool of investors that have stayed away from this market, what else do you think they will need to hear before we sort of bridge that gap between this dissonance in information around this market?
I guess what makes markets go up is confidence. And there's often a helpful feedback mechanism that when you get higher markets, you get this wealth effect that therefore affects the real economy. I think we saw that in the US in the global financial crisis in 2008, 2009. The market was a leading indicator. And that might be the case here in China too. So I think the authorities now seem to be committed. But even if you don't get the exact right requirements, as long as that confidence sustains, that alone can cause consumers to feel better and to ease the negative sentiment that we've seen in China.
I think most say it's understandable that you can see sentiment overshoot, but at what point do we need to go back to the fundamentals, right? Do you actually see what we've heard so far is enough to give you a bit more clarity on what the earnings outlook is going to look like for some of these companies that you hold?
I mean, we take a long-term view of equities, and we were buyers of China even before we saw the stimulus come through, just because at some point the cycle turns. You know, it's better if it happens quicker because of government action. But it would have happened anyway just because of the cycle. Some companies would have gone out of business, etc. So on a long-term basis, we think it's the right place to be. Now, whether or not the stimulus works in the very short term, I guess could help things along. But based on our long-term assessment, price versus value, the value is there, and that's why we're positive on Chinese equities.
Yeah, the mindset of these markets, and we were talking just before the show started, right? I mean, we've somehow been here before during this bear market. 20-30% up, and then we sort of pulled back down, and then 20-30% up again. This time feels different, question mark, almost. How do you feel right now, short term, which I know is very difficult to call, the next 3 months or so? Is the direction of travel still up?
I mean, it does feel different, but maybe that's because it's still up. You know, maybe I feel differently if the market fell back 10%.
Yeah.
So it feels different. Look, we can't call the short term.
Okay.
We can't call the short term movement, but all we can do is price versus value, and we think that is compelling.
Okay.
Have you gotten more inflows? Or inquiries at least?
You know, a little bit. I think it's been so quick that our investors haven't had time to react. But I suppose we have got some inflows.
And what is the exposure now to China? Is it more in the cyclical, as you say, more consumption-related stocks? And what other parts of the market do you think you've kind of done well in can continue?
So we bottom-up investors, so we don't tend to concentrate on sectors, but we do have a significant weighting in the H share market, where we think that's where you get the valuation opportunity and also the, I think overall better companies.
Okay.
We also got some US ADRs. For the China A share market, it's always been a market that we've considered to be expensive. And really it was beginning to look attractive. We did increase some A share holdings, but our exposure remains overwhelmingly H shares and US ADRs.
Do you anticipate that to change? And simply the reason I ask you that is most of the measures recently seem to be directed to the A share market.
Correct.
Yeah.
We don't expect it to change. It might.
Sure.
You know, the Asian market just tends to be more expensive. But you're right, that they do enjoy a level of support that the other markets probably don't.
Your other sort of big market that you focus on is Korea, and you've been really focusing on this value up program. There's been a lot of controversy around it, whether it's the stocks, the selection, and the like. But I'm just wondering, do you think it does anything to move the needle on reducing that Korea discount in this?
Well, Korea now stands alone as the only cheap market, right? So we're quite excited about it. But in order for, I guess, the bazooka in that market, like perhaps this was the bazooka in the China market with the stimulus, the bazooka in the Korean market would be two key steps in improving, I guess, governance. One would be introducing a fiduciary duty. And the other would be cutting inheritance tax significantly. And both of those things are under consideration. But those could drive Korea like the stimulus that driven China.
Yeah.
So, I mean, talk to us about the Korea discount, first and foremost. What do you think that exists? And the incentives to your point, don't seem to be aligned with higher share prices. And do you think there's appetite among policymakers in Korea to actually address the primary issue here?
So 90% of Korean companies are controlled by families, and they often run, which is an unusually high ratio, they often run these companies to serve their own interests. Now, it's in the interest for many of them to keep stock prices low, because inheritance taxes right now are 60%. So low stock prices means lower inheritance taxes. And the other thing is that the Korean laws at the moment are substandard, and they allow controlling shareholders to benefit at the expense of minority shareholders. They can do all kinds of things that don't require approvals that would be required in other markets. So the incentives right now for the people who control Korean companies is to keep governments poor because they are benefiting from the poor governance, and for many of them to keep stock prices low because they are benefiting from low inheritance tax that would apply. So the government really needs to address those two things. Fiduciary duty, which amazingly is being resisted. It's quite hard to philosophically reduce the introduction of a fiduciary duty, but I mean, what do you say, right? But these guys are doing it. And secondly, to reduce inheritance tax. But we do believe that the authorities are more serious about it. There are a lot more voters in Korea that are now trading the markets post-COVID, and they are interested in things improving for the first time. So you've got this powerful voting bloc of individual investors within Korea that are pressing the government to do the right things.
All right, Jonathan, thank you. Jonathan Pines, their portfolio manager at Federated Hermes, joining us there in our Hong Kong studios. Take a look when it comes to futures here right now. And yes, we continue to see that this rally can continue for another day. Look at that. We're punching some 2% right now, so it looks like it could be a good open in Hong Kong. Futures in Hang Seng as well are slightly bid up this morning, 709.41. Still talking about a little bit of weakness, though, when it comes to the currency here this morning. Plenty more ahead. This is Bloomberg. All right, we were checking Hon Hai shares here this morning, and they were seeing a pop about 1.5%, 2% in Taipei. After what we heard from some of the revenue numbers, there's a rebound there, which is really thanks to this whole AI sort of wild ride we've seen. But the company is saying this is probably a record when it comes to third quarter sales for that period as well. And it really is lifting, I guess you could say, most of the tech complex here in Asia. TSMC is up some 2% as well. Let's get to our tech reporter, Annabelle Jewelers. She joins us live from Taipei with more details. And Annabelle, I know it's a big week for Hon Hai as well, but what stood out to you in those numbers?
Yeah, well, it's exactly as you say, Yvonne. It's that focus on AI servers in particular. This is perhaps a segment that Hon Hai is not known for as much as being an iPhone assembler, but it is really becoming one of the lead revenue drivers for the company. AI servers, it's using NVIDIA chips made by TSMC that are put onto a main board, put into a rack, that are sent off to hyperscalers in the AI cloud space like Amazon, like Microsoft, like Alphabet as well. Hon Hai is really a big part of this infrastructure right now in the AI server market, and this is where they're really starting to generate revenue that is offsetting the decline that we're seeing in other parts of its businesses, particularly in the consumer electronics space, where part of its market share in particular is being taken by Luxshare, a competitor in China. But that's the focus of these third quarter numbers. They came in better than what analysts had been expecting. As you said, the company said it was a record for the period as well, but sales are around $60 billion. This is, as you said, a big week for Hon Hai because we're heading into Hon Hai Tech Day. Kicks off on Tuesday. First time we've ever seen it being open to the public. Just shows you that level of interest in the company at this time as well. But a lot of big interviews coming up, including with Hon Hai's head of EVs, or the man who's leading their EV efforts. A lot of questions around this particular business, whether it can really ever be a major revenue driver. But Jun Seki will have his insights exclusively on Bloomberg Television tomorrow, and a whole lot of other big guests on.
Yeah, we can head to that, Bell. Thank you so much. Busy next few days there for Bell over in Taipei. Alongside the key interview coming up as well with the reopen in mainland China. And, are we looking ahead to it? Absolutely, yes. Are we going to get gains? Absolutely, yes, if you base it on some of how the futures are trading right now. So while China was shut, A50 futures in Singapore are up 17%. So catch-up trade. In fact, we might have to even get into the nitty-gritty of the pipeline of the markets here. CCTV reporting that some of these exchanges are running tests today ahead of that reopen tomorrow. So keep in mind, right, if you get a fair amount of stocks opening limit up, then you might get a fair amount of the market that won't be trading at some sort of brief periods of time, because that's just as high as things can go. Watch it very closely. It seems to be we'll be getting a massive pop at the reopen tomorrow. Right, just to take a step back as well, we were talking about this. So coming into this Monday, HSI was already up 31%. So the last 3 weeks have been the best 3 weeks for Hong Kong, HSI in particular, going back to 1975. Now, as far as buying momentum goes, we have a fear and greed index. Certainly greed has been, I guess, above and beyond in terms of market forces here as well. Let's flip the boards, please, and have a look at that. The fear and greed index is back to the highest level here since the boom and bust back in 2015. So ahead of that, we're up 90 points in the Hang Seng China Index. We are poised to open higher this Monday morning. This is Bloomberg.
Welcome back. You're watching The China Show. We are ripping higher when it comes to the Hang Seng here once again, after what we already saw was one of the best 2 weeks or 3 weeks we've seen in 5 decades when it comes to the Hang Seng. 8 shares are seeing similar sort of superlatives here. So it looks like on the eve of before China markets reopen on shore, it looks like this rally could continue. And as Dave just mentioned, there's quite a bit of upside in terms of catch up there. Goldman Sachs just upgrading Chinese stocks to overweight, and they're saying, 10 to 15% higher could still happen here as well. Dave.
Yeah, 84 is their new target on MSCI China over the next 12 months. 4,600 is their new target on the CSI 300. More on that, of course, later on. Ahead of the open, we're looking at 1.8% on A50 futures, so that translates to about 18% higher now since mainland China went into the Golden Week break. So it gives you a sense of what sort of potential upside we'll get tomorrow. 23,000 now on the Hang Seng Index. HS Tech is at 1.7%. We're also getting, in terms of the economic numbers coming through, our latest Bloomberg survey is out on Hong Kong, and they are raising their growth forecast for the year to 3%. So, in terms of the economic story, that seems to be pushing even higher. Tencent up 0.25%. HSBC is also, as you can see, bottom of your screen, is also seeing some upside there as well. Right, flip the boards, please. And certainly it's this NDRC briefing that was announced over the weekend that seems to be pushing stocks even higher. What should they announce tomorrow that could give markets a further leg higher? So some of the financials that have led this rally are continuing to see substantial upside. CICC and China Merchant Securities up 13%. JD.com, massive move up in the U.S. on Friday, 1% higher right now. Trip.com not so much mirroring its gains that we saw on Friday, although it is a broad-based rally. Very quickly, we're looking at high board today, want to watch. We're up 10 straight days. So has this market put pressure on money supply? Yes, it has. Do we get day 11 right now? And in terms of everything is up, but if you take a look at underneath the hood, one specific group of stocks has really outperformed the rest, 30, 40% higher. If you take the weekly performance spread between Hang Seng China, which is almost purely mainland plays, over the Hang Seng Index, you're seeing a third week of outperformance there. So it's really what's happening onshore. It's key here, I guess.
So you mentioned what are the next catalysts? Well, maybe it could be this big meeting tomorrow here with China's economic planner. We'll host a news conference tomorrow to discuss the implementation of incremental economic policies. Now, this comes as this world-beating rally in Chinese stocks is failing to convince some global fund managers and strategists. For more, let's bring in our China correspondent, Min Lo. So, Min, what are we expecting from the NDRC tomorrow?
Yeah, well, the market rally has been really hard won. So the bar is really, really high, right? The NDRC and the government really has to beat expectations to keep that rally going. So we're looking out for whether there will be measures to shore up consumption, private sector growth and investment, social security benefits to support employment. For example, I just spoke to an economist based in mainland China, and she believes there'll be more of that 两新政策. That is the equipment upgrading, industrial equipment upgrading, and consumer equipment upgrading program that we'll maybe hear more of, and maybe some more details about bond issuance. Now, that is the purview of the Ministry of Finance, but the NDRC has the power to approve projects that these funds will be used for, and markets have been really disappointed by the pace of local government special bond issuance and usage, and a part of that has been the lack of suitable projects to invest in. So will the government announce maybe a widening of those bond usage to buy back unsold homes, for instance? So these are some of the things that we'll be looking out for.
Okay, Min, thank you so much, Min Lo there, on giving us a preview of what we can expect out of that NDRC briefing around this time tomorrow. Let's bring in our team right now to talk us through the key themes to watch. We're 35% into this rally, what questions we need to be asking. Marvin Chen is here with us out of Bloomberg Intelligence and out of Bloomberg Opinion. Shuli Ren is also here with us on set. Marvin, let me start with you. How do you think things are going to reopen tomorrow? Dumb question almost, but yeah.
Yeah, so the Hong Kong markets were still pretty strong during the holidays, up 8 to 10%. So we think that suggests A shares will open up with some positive momentum. But really the China holidays was a chance for offshore and foreign investors to kind of catch up to the onshore sentiment that was really leading the rally prior to the holidays. We think some A-share sectors could open with particularly strong momentum. For example, if we look at the best performers in Hong Kong last week was the China non-bank financials, or more specifically the brokers, which were up 50 to 100% in just 3 days. So, a lot of these stocks are dual listed A and H shares. So, this gap up in the share price difference will likely converge once the A-share market reopens.
And there seems to be still some skepticism, right? I mean, given the run-up that we've seen, Marvin, some managers globally are still not convinced about this rally. I think Nomura even calling it brace for a potential crash as well. So how much do you think are foreigners really kind of buying in on the story now?
Yeah, I think the Hong Kong market performance last week was a good indication that foreign investors are buying in. But based off of some of our client conversations, we do think there's still a healthy amount of skepticism amongst global investors. And, this is reflected in the short balances as well. If we look at the short positions in the onshore market versus offshore, the onshore market has come down much faster than the offshore market, which kind of reflects the difference in sentiment between on and offshore investors. The other thing we'll be looking at is the northbound Stock Connect flows. Now, this is reported on a quarterly basis. We'll get data on that in the coming few days, and we expect to see some pickup towards the end of third quarter.
And Shuli, I'll bring you in. You know, there's, I guess, a fair amount of investors that may have missed the rally. They've sat it out. They want to see where this settles and goes. Your latest piece talks about how investors should be looking at this rally at this point in time. Yeah, just take us through the thinking there.
Well, they have to because the China market has caught up to the U.S., right? And we see that the U.S. momentum easing off. And then if global investors want to beat the benchmark, they have to look at China. And unfortunately, before this crazy rally, they pretty much exited China entirely. Like shorting China and the long U.S. big tech are the two most popular trades. And you can have their investors, the pension funds, mutual funds, etc. They will ask, the China stock equities are not expensive despite the recent rally. It's only trading at 11.5 times forward earnings, half of what S&P 500 is trading at, right? So they do have a dilemma whether to chase after this rally after the initial 30% rebound.
Yeah, and does it spark some sort of re-rating, right? You're saying China is reshaping the world in investing. In what sense?
Well, in China, there is no a slow bull as President Xi Jinping has been hoping for. It's just a 0-1 switch on or switch off rally. And then China is, after all, the world's second largest economy. It affects foreign exchange, commodities, and everything. And we just suddenly, even when you talk about the U.S. Federal Reserve's rate decisions, are we in a reflationary period, in which case the Fed cannot even raise rates further anymore, right? That's a problem with investing in the world, even if you want to do ex-China, because you cannot ignore this big elephant in the room, which can be sleeping for a long time and suddenly waking up.
Yeah. I mean, Marvin, you and your team have been very busy, I would imagine, during this, 3-4 week window. What are some of the most common questions you're getting from clients these days?
Well, it's really, how much longer can this go? Is this time different? As Shuli mentioned, valuations now 11.5 times. It's really approaching the 5-year average, and we're kind of going into this territory where it's going to be about show me. Right. It's going to have further index gains are going to have to be backed by earnings and fundamentals.
Shuli, that big meeting tomorrow. We were talking just this morning about, do you actually need an actual big number in terms of a fiscal package to get this rally to continue, or we need to look for more nuances?
I think if the rhetoric is good, tomorrow, my expectation, they're having the 10 a.m. meeting, right? And a lot of retail investors are scrambling to open stock market accounts.
Yes.
So I expect the Asia to basically go 10% or whatever. And then if the rhetoric is strong, Asia market can still rally, because we know the Chinese onshore market is kind of like India's. It's very momentum and retail driven. We've seen that before, right? So not necessarily the concrete numbers that we need to see. It's just a rhetoric. I think it's more important.
And maybe a question for both of you. Marvin, I'll start with you. Over the weekend, we were looking at social media, and it seems everyone is looking ahead to the reopen. People are opening up their brokerage accounts. The state media is reporting that they're ordering the exchanges to test their systems and run some tests today. Will the systems be able to cope with this flurry of buying activity tomorrow? Well,
the Shanghai exchange failed a week ago, so hopefully they've done enough testing and are prepared for today. Yeah. So,
Julie,
I think the employees at those brokerage firms are just so happy they have work to do right now.
True. Yeah, I think they were swarming the streets, I think.
Yeah, sitting on sidewalks.
Media, getting people to open some stock accounts.
It's a good problem to have.
Yeah, I'm sure they're getting a lot of traction as well. Marvin Chen, thank you, our Bloomberg Intelligence analyst, and Shuli Ren, our Bloomberg Opinion columnist, joining us on what to expect, of course, across these Chinese markets. We've been hearing a lot of people, commentary, talk about what to expect tomorrow. I think tomorrow is going to be a pretty crucial day.
Yeah. We're going to be glued to our television sets, of course. No, not us, of course. You'll be glued into us, hopefully. Chen Wang, out of Vanguard, we spoke with him earlier. She's the chief Asia-Pacific economist there. And we asked her what her expectations are ahead of that crucial briefing tomorrow. Have a look and listen.
But the second stage is really what they are going to do to revive the demand in the economy. And that is where I think all the eyes are actually on the fiscal policy, right? So I think, down the road, I mean, the NDRC press conference, as well as, probably later in October, what the National People's Congress, they are likely to approve more supplementary fiscal package, right? So that I think is going to be in the focus for the market to see what they can do to support the consumption as well as the overall economic growth.
Okay, so we'll see what they announce this time tomorrow. But in any case, markets don't seem to be asking any questions right now. We're still seeing a flurry of buying activity taking place, up 2%, and certain stocks are moving substantially.
Yeah, if you were puzzled or scratching your head on Friday on what really happened with some of these chip stocks, well, you might see that again, because we were already up some 29% for the likes of SMIC. And here we go. We're seeing another sense of double-digit gains for that chip maker in particular. And Morningstar did cite maybe it's these expectations of further government support for the chip sector that is leading SMIC, like Hua Semi. We're watching some of these really chip stocks continue to surge this morning. We're up close to 20% gains right now. Plenty more ahead. This is Bloomberg.
Right, welcome back. You're watching The China Show. Happy Monday morning. And right out of the bed, we're seeing investors sprinting. As you can see, we're now nearing 40% gains from the September low on MSCI China. So just keep that in mind. We are seeing the rally continue. That's despite, of course, some of the skeptics. There's a big story out right now in the Bloomberg talking about that, and also, of course, some of the news coming out of Europe on Friday.
Yeah, so they did actually go ahead, in fact, when it comes to that vote of imposing tariffs of up to 45% on Chinese EVs. We're taking a look at some of how these EV makers are doing. They actually did rally on Friday in the U.S. session there. But you take a look at when it comes to what we're seeing so far, it looks like right now we are still seeing EVs are doing quite well. Maybe not so much on the geopolitical risk, but really on what to expect out of these fiscal measures and this NDRC meeting tomorrow as well. But let's bring in Linda Liu, our Bloomberg Asia transport reporter, more on what we heard from the EU and really kind of unleashing this sort of, I guess you could say, trade battle now with China. What's next to look out for?
Yeah, so now with this vote that has passed the EV tariffs, the European government has until November to implement these tariffs. So within this little bit of time, the Chinese government actually is still trying to negotiate with the EU to try to further reduce the rate of these tariffs. Volkswagen CEO actually, interestingly, in an interview with German media, suggested that there could be exemptions for Chinese automakers that decide to invest in Europe, as well as create jobs, to maybe exempt them from some of these tariffs. So there are different options on the table with eventually the form that these tariffs will take.
And what kind of impact are we expecting now, whether that's country to country, business to business, consumer to consumer? What are we watching out for there?
Yeah, the really big thing we're all watching for is whether this will escalate into an all-out trade war between China and the EU, because Beijing over the past year has threatened to also levy tariffs on a range of products such as brandy, pork, dairy. So all of these, some of them are going through an anti-dumping investigation right now, and how that could go will probably depend on how the EV tariffs will play out in the EU. Other than a trade war, with Chinese EVs potentially becoming more expensive and harder to get to the EU, consumers in the EU are also going to lose out on more affordable EV options, which in the long term kind of hurts the EU's transition to, zero emissions transport.
Linda, thank you so much for getting us up to speed there. Linda Liu, our Asia transport reporter. Let's get to some other corporate stories that we're tracking and watching this Monday morning. So Bloomberg has learned that Tencent and the founding family of Ubisoft are, well, weighing options, including a potential buyout of the French video game developer. Now, sources say Tencent and the founding family, of course, are speaking with advisors here on how to stabilize the company after it lost more than half its market value so far this year. Now, shares have jumped 33% on Friday following that specific Bloomberg report. Now, Hong Kong's biggest developer, Hon Hai, has sold 204 apartments on Saturday after offering a discount aimed at boosting sales. And the units were the first batch in a 906-unit development and were priced at, get this, 20% lower than nearby new projects. Now, while Hong Kong's recent reduction in mortgage rates has lifted sentiment, developers are still facing a challenging outlook marred by an oversupply of homes. Now, Rio Tinto has confirmed it's made an approach to acquire Arcadium Lithium. Now, Rio says the approach was non-binding and there's no certainty any deal will actually be agreed to. In a separate statement, the company confirmed that it had been approached as early as 3 months ago. Citi analysts suggested that Rio should buy Arcadium, with the lithium miner trading well below its replacement value. Shares at Rio, as you can see, down 1.5%. Plenty more ahead. This is Bloomberg.
Well, we're still talking about the Fed, despite, of course, we're seeing this Challenger rally, although losing a bit of steam here just a few minutes after that open here. But we did hear from Bloomberg opinion columnist Mohamed Al-Arian, who also thinks that the latest U.S. jobs reading means that expectations for Fed rate cuts are overly aggressive. The Queen's College Cambridge president told us what he sees as the key priorities for markets and the Fed from here.
So thanks, John. 4 takeaways, including for the Fed. One, on the labor market. This is not just a solid labor market, but if you take these numbers at face value, it's a strong labor market late in the cycle. 2, for the economy, it speaks to U.S. economic exceptionalism, something we've seen and something that's continuing. 3, for the Fed, it means push back much harder against pressure from the markets to put you in the single mandate box. Enough talk about inflation is dead. Inflation is not dead. Enough talk about the Fed should only be concerned about maximum employment. It should still be concerned about its dual mandate. And finally, for the markets, I think this is pushing back against what has been, in my view, and you've heard me say it over and over again, an overly aggressive expectation of rate cuts by the Fed. I think this will get the market closer to what's likely. And then we're going to have a debate on 2 things. One is, where's the neutral rate? And 2 is, how do you think about this economy in terms of growth and employment, and how are these 2 things coming together? So, at face value, this is a report that will cause a lot of revision, both in analysis and in market pricing. But I stress, it is part of a much bigger picture of mixed data. And that's where the complications arise, John, as you know.
Mohamed, Emery nailed it when she started saying, how much does this have to do with the 50 basis point rate cut? And it's somewhat tongue-in-cheek, of course, but at the same time, there is a real question. How much have the easier financial conditions that have basically been manufactured by this Federal Reserve helped boost a market that wasn't maybe in need of such a big boost?
Look, my view, we've been living in a world of liquidity dominance. It has been all about liquidity. That world was reinforced by a 50 basis points cut. Let's also remember that the market didn't expect a 50 basis point cut based on data. It expected it based on a reporting on the Thursday before the Fed board meeting. So there was no economic conditions that would justify 50 basis points, but there was a leak to a newspaper that moved market expectations. I worry that we continue to feed this monster of liquidity dominance, and at some point we may regret it, either because inflation will not settle at 2% and or because financial instability will result from excessive risk-taking.
There we go. That was the big news, of course, we woke up to in the Asia-Pacific over the weekend. Will the Fed be able to cut, right? To what extent? Mohamed Al-Arian there our Bloomberg Opinion columnist, speaking with our colleague, Lisa Abramowitz. Right, going back to markets right now, so there's a Fed conversation, there's this flurry of central bank action this week, not to mention earnings as we move into the latter part of this week with JP Morgan set to report, but the big one is tomorrow with China and what they will be announcing. What's happening in these markets is a massive gap higher at the open, and since that point, we've seen pared back most of these gains, and we're now trading slightly just above water for some of these benchmarks right now. Still, though, as you can see, tech is still leading this about 1% to the upside.
Yeah, the chip sector is certainly what's been driving that, especially when it comes to some of these domestic names that we're seeing across China. So 14% gains are extending already a close to 30% jump that we saw with SMIC on Friday. Hua Hong Semi jumped by a record 30% last week as well. And we're seeing continued gains for that company. And so certainly that's one thing we're watching very closely. So HS Tech is still looking pretty strong despite some momentum being lost on these major benchmarks here as well. We're watching New World shares as well. We've been talking about this company, obviously, after we heard from the earnings and the change in the CEO as well. So Morgan Stanley upgrading that price target there when it comes to New World, and that is helping the stock up some 2.5% today. Coming up the next hour, we're going to be discussing the latest when it comes to Hong Kong's retail sector with the father of Hong Kong's nightlife, Kwai Fong Group Chairman Allan Zeman. Plus, we'll be joined by Johanna Chua from Citigroup, head of emerging market economics, about FX rates across the emerging Asia region and what she expects from this NDRC meeting tomorrow. This is Bloomberg. Welcome back to the China Show. We're just a day away before mainland markets reopen after that 5-day Golden Week holiday. And there certainly is a lot of anticipation of what we could see, not just across these markets, but what policymakers from the NDRC are going to say in this briefing on Tuesday, 10 a.m. So tomorrow at this time, we will bring you those details live on this show and whether it actually continues for this rally here. In terms of the Hang Seng, it looks like we've been teetering between gains and loss. Well, I guess you could say we lost a bit of momentum, but we're still talking about gains of close to 1% here right now, here in Hong Kong, Dave.
Yeah, and we're up 35% still.
Exactly.
for 3 weeks ago. So why not take money off the table? To Yvonne's point, right? So I'm going through the invitation to journalists tomorrow. I'll take you through some of the details here. So we have the chairman of the NDRC. Several vice chair people are also joining at briefing tomorrow. There'll be simultaneous English translation will be provided. So in other words, the messaging will not only be to domestic audience, but certainly a lot of the global investors will be tuning into this time tomorrow. So
for those of you that are still unconvinced, will belong only funds.
Listen in.
To listen in.
Because it might indicate to, I think, we did just get some of the notes coming out of UBS. Wang Tao, who's an economist there, of course, coming through as well. In this hour will be Johanna Chua. The signaling from what they will say tomorrow might indicate bigger and more meaningful fiscal stimulus ahead. And, some of the numbers that are in these strategist notes are just mind-blowing. 10 trillion
10 trillion renminbi.
10%, right, of GDP. So if you're looking for something of firepower, this actually could be it on top of the monetary element already we've been talking about as well. But as you can see, we're looking at gains here, not to mention, of course, maybe a Fed that's probably not going to ease as much anymore. We'll see how the story changes. Let's bring in Mark Cranfield out of our MLive team joining us right now this Monday morning. Mark, what's top of mind for you?
The NDRC is a very significant development. The timing of it, obviously, is really amazing for people. So China's going to come back from a holiday. The markets will only have been open for maybe half an hour or so, and then we're going to get this NDRC press conference. And they've obviously seen the success of the PBOC-led press conference 2 weeks ago, and they must be thinking, well, this is exactly what we need to do. People are coming back. We don't want any chance that traders come back from their holiday thinking that the best is already over. There's got to be more to come, and we're going to remind them that we're still going to be throwing money at the Chinese economy. We may even give them some precise numbers like you were discussing there. There could be some signals about just how much more stimulus is going to be coming down the line in China. And so they want to drive that message home again as soon as people return to action on Tuesday. So it really, you cannot camouflage how significant the timing is of having that kind of press conference just after a holiday. So it may not be the last either. There may well be more messaging to come over the days ahead. This has to work for China. The joint fiscal and monetary policy, those two levers have never really been in tandem as much as this, really, since the global financial crisis. So there's no turning back. China has to make this work. They have to see success in terms of improving the economic data and making sure stock markets are on a much solid footing. So the press conference tomorrow is another step in that direction, and we can expect there'll be more. There might be more rate cuts to come in the next couple of weeks as well, but surely they have to keep on reinforcing this message to make people believe this time is different. This time we cannot fail.
And we were just talking to Shirley Ren as well. Like, do we just need to keep the rhetoric going, Mark? Do we need a specific number to really satisfy this market, or you know, what do you think is going to be needed in terms of tangibles?
Yeah, certainly. Some of the huge numbers being sent around, like as you say, 10 trillion yuan and these kind of numbers, people will probably expect to see some meat. You can't keep talking in abject terms. You have to eventually put some concrete numbers on it, just in the way that the PBOC did with the support fund when they said it could go up to $1 trillion yuan. That's a very significant number for a fund that can support equities, and they probably haven't even needed to spend a single amount of money yet. It's just there in the background. People know it's there. So they will need to put some real numbers on it. But in the meantime, they can also talk about the big picture. They can talk about the different levers they're pulling. But yes, investors won't wait too long before they need to see some concrete numbers to tell you how much is going to be spent and where it's going to be spent in the months ahead.
Mark, just to turn our attention to the other big story, that blowout jobs number on Friday. You know, suddenly Monday morning we're talking about 149, 150 on dollar yen, 4% on your, whether that's your 2 or your 10-year yield to that point, right? They're almost again back at parity. Is the easing cycle at risk, and what does it mean for markets if it is?
I mean, it's really the turnaround in the past couple of weeks is really amazing. We've gone from the Fed cuts 50 basis points, expectations for another similar amount in November. Now we're not even sure if we're going to get 25 basis points. And if we get a CPI report this week, which is on the hot side, it could be all bets off for November. It could be that it'll be too close to call even for any kind of interest rate cut at all. So no wonder we're seeing high volatility in the Treasury market, which was pricing for significant rate cuts all the way through to the end of next year. People are having to dial back very quickly on those expectations. The Fed now has a very different, the messaging is going to have to be very careful from the Fed not to cause a massive dislocation in the Treasury market. Somehow they need to persuade Treasury investors that they are going to lower interest rates, but they may need to do it at a slightly lower pace. And they need to avoid the risk that people really throw all the baby out with the bathwater here and think that they're going to go all the way back to rate hikes before too long. Then they really need a cool inflation number this week. That will help them. And that then maybe they can keep on track. But definitely the possibility here is that November is going to be too close to call, and we may need a pause. The Fed may have to do it, because that 50 basis points cut in September really looks like overkill in terms of an unemployment rate at 4.1% when we were at 4.3 not too long ago. It looks as though they've done too much too soon.
Yeah, I think Larry Summers said it, that maybe that 50 basis point cut last month was a mistake. Mark Cranfield, thank you, our Bloomberg MLI strategist, joining us out of Singapore here this morning. And still ahead on the China Show, we're going to talk to Citigroup, why Johanna Chua expects softer upcoming data to really lead the Fed to maybe if that 50 basis point rate cut that could still be alive in December, she says, but maybe push back from November now. She joins us in just a few moments. But first, a look at Hong Kong's troubled retail and entertainment sectors and why a rise in mainland tourist numbers may not be enough to turn things around. That's our China Decoded segment that's coming up next. This is Bloomberg.
Welcome back. You're watching the China Show. Happy Monday morning, by the way, if you're just joining us. A beautiful weekend, by the way, in Hong Kong, right? The weather was immaculate. And going into the setup for the reopen in mainland China tomorrow, it seems to be almost as immaculate as it can be going into this market open. By the way, this is China Decoded, our segment where we go in depth at some of the stories and issues affecting the world's second largest economy. And this week we take a deeper dive, and I mentioned Hong Kong and the weather, the retail sector and the F&B sector here in Hong Kong. So just to get us up and running here, the latest Bloomberg surveys out from economists, and encouragingly enough, they bumped up their growth target for the year, growth projection for the year to 3% from 2.6%. It was the prior estimate, so that's good news number one. Good news number two is, as you can see on your chart, this actually tracks restaurant receipts. This is government data, quarterly data. So as you can see, we rebounded from the bottom of 2022. Give or take, there were still about 15% on aggregate lower than the peak back in 2019. So it's not just about the number, but how have things really changed underneath the hood that contribute, of course, to where growth is here.
Yeah, because the headline numbers still look a little bit weak, right? You take a look at what we saw in terms of retail sales value that fell just over 10% in August from last year, which was more than estimated. The estimate was for about a 9% print, negative, I should say. But Bloomberg Intelligence thinks that stronger growth in mainland Chinese visitors still won't be enough to make up for reduced spending by residents for the rest of the year. Let's bring in our senior analyst, Catherine Lim, joining us now. And Catherine, just tell us what the outlook is when it comes to retail sales for the fourth quarter here in Hong Kong, and what are going to be some of those drivers that are worth considering for next year?
Well, Yvonne, from where things are right now, Hong Kong retail sales needs to go up 20% in fourth quarter to actually make up for the shortfall that we have seen in the first 8 months of 2024, and it's likely still going to be a decline in September. So going into the fourth quarter and 2025, really watch for the currencies. I do think that, this is one of the factor that we need to factor into consideration, not for the Chinese coming into Hong Kong, but really I think one of the biggest drag that we have seen on the Hong Kong retail sales was the northbound traffic, i.e. from Hong Kong to Shenzhen and to the Chinese cities itself, where services expenditures are generally cheaper in Hong Kong.
Okay, well, let's put that together with, I guess, some of the short-term flows, Catherine, we've seen. I think the data out of the government is a 35% increase in mainland arrivals in the city. Now, is this good news for retail sales? I guess another way of asking that is, did the same amount of people spend the same amount as far as that growth rate is concerned?
Well, that's a good question. And I really don't have that answer right now because, if I look into the China stimulus, the exciting things that, we've actually seen into the last week of September, I think that was a little too late and it may not have been factored into the National Day spending as we speak right now. I think over the weekend, and we're looking for some of the numbers to come out over the next couple of hours itself, even travel spending seems to have been cut back a little with, reductions in prices for hotels as well as for some of the travel budgets. So, I don't think that's really going to translate into the retail sales numbers for the first few days of October, and we really have to see what happens over the next couple of days. And don't forget, we're coming into the Singles Day shopping festival too, and I'll be surprised if anyone is actually spending ahead of this big bazaar.
Yeah, why not? If discounts are coming, right? And I think that's a really good analogy for things like the housing sector, which that's another door that I unfortunately opened. Anyway, Catherine, thank you so much for staying up. Catherine Lim, Bloomberg Intelligence senior analyst there, just getting us up to speed really in the status and the snapshot of the retail sector, which is really part and parcel to the conversations around F&B here in the city, and this massive flow of people that go north on the weekend, spending their money in the likes of Shenzhen and Guangzhou, for example. What does it mean for the city's F&B industry? Joining us here on set is Kwai Fong Group Chairman Allan Zeman, often referred to as the father of Hong Kong's nightlife area. It's nice to see you, Allan. It's been a while.
Good to be back.
The issue, some of the headlines we see,
yes.
Restaurant this closing down, restaurant B closed. So that's what we see on a headline basis. It's an issue where almost everyone has a theory. So what's the prognosis from people like yourself?
Well, I can tell you what a difference a week makes. The Golden Week in China, actually this past week, we had 980,000, the last 5 days, 980,000 mainlanders coming to Hong Kong. And basically, they spent. Shopping malls were up about 8%. So Kwai had reported they were up 8% in theirs. A lot of people buying. Well, restaurants are very, very busy. I mean, there were lineups if you went around Hong Kong at the time, which you haven't seen for a long, long time. And so restaurants are very, very busy. And then we had they were buying jewelry, they were buying gold, they were buying cosmetics. So taking a lot of that. I even saw some people in Causeway Bay had spent $100,000 on some luxury goods and $200,000 on some bags and that kind of thing. So, obviously the stock market in China, the wealth effect was really, really causing a lot of people's strength and as well, China. Real estate was 25% of China's GDP in the past. And the problem was that because of the too much real estate on the market and all the problems. And so, and real estate is a wealth effect. And now with all the stimulus package, and there's, I think, 800 billion won that's ready to go into the stock market, in China. So people feel better. And they've also the lower mortgage rates in China gives people also wealth effect. Guangdong lowered all their taxes, their different restrictions on real estate. Same thing in Shenzhen and in Shanghai. And so people are now starting to buy. And there's just a few real estate deals done in Shanghai, and they move very, very the higher end, and they move very, very well. So that's the beginning. And the same thing's happening in Hong Kong. Hong Kong, you saw there was sellout in Kai Tak in Sun Kai
after massive discounts, though,
massive
right?
discount. Yeah, I saw one of the owners
20% discount,
and they and he said they lost money on everything they sold, but it doesn't matter. It starts, and that helps a lot, and that helps the retail market. The big problem we have in retail, obviously, as Catherine has mentioned, on the weekend. About 200,000 people leave Hong Kong and go to Shenzhen, which is really 35 minutes away, 40 minutes away from Hong Kong, and 40% cheaper for restaurants, for spa, for hotels. Everything is it's a new world for them because of our strong Hong Kong dollar. That's really hurt Hong Kong a lot. I mean, the peg to the U.S. dollar. Obviously, we've had it for more than 40 years, and it's always been great stability for Hong Kong. But in this case, because of the high inflation in the United States, that's really hurt us.
Is that a new normal, you think, Allan, in some ways? Like
I
a
don't think it'll
phenomenon,
be 2026. I don't think because, yes, they lowered the interest rate by 50 basis points, and that's the first point. I'm not sure if it'll continue. It won't go 50, I don't think. I think it'll go 25 basis points if they do. So I don't see it before 2026 because we don't have inflation in Hong Kong.
How does Hong Kong compete with that then, if everything there is so much cheaper?
It's difficult, I can tell you. It's a new world because we're suddenly discovering China, which nobody in the past wanted to go to. And all the products that they offer are very, very good, in fact. So we've got to step up our game. As well, in Hong Kong, well, I can tell you from Lan Kwai Fong, the area that I control, it's a different change. We were mostly expat in the past, but during COVID, 200,000 people of expats left Hong Kong because they didn't want their children to do online learning and 21-day quarantine, all that, and many did not come back. And so that changed, and then, of course, 150,000 locals got B&O passports. They went to the UK. So that changed the dynamics. But I sit on the Hong Kong government's board for human resources, and that helped a lot because we had new talent schemes, and basically we started with 35,000 with certain criteria to attract 50 international, 50 mainland.
Well, that didn't happen.
Well, what happened as of 2 weeks ago? We got 346,000 applications with different different talent schemes, and with that we've approved so far 240,000, and so far to date 143,000 mainlanders and their families colleagues have moved to Hong Kong. So you see the schools with their kids, the schools are full again. They're renting. The rental market is the highest it's ever been. They're not buying property in Hong Kong. And so that's changed. And for myself, we're changing. We're now leasing to a lot of new mainland companies.
Right.
And that's really, I've got a Michelin star restaurant, one Michelin star restaurant, Chengdu from Sichuan, from Chengdu, Sichuan. I've got Meike TV, which is a public company. They have 500 in China, and they've got it's publicly listed in China. Very, very popular. The first one going to be in Lan Kwai Fong. All the newspapers, everybody's very excited about that. I've got Chow Chen Men, which is a hot pot restaurant from Chongqing, and these are all new imports. I've got more coming on the way. So because the demographics of Hong Kong has changed. We are international. We have our one country, two systems. We have the common law system that we practice and all that. So Hong Kong will remain, but we're going through changes.
Well, the target market. I mean, you mentioned, I was mentioning, in terms of the absolute number of people that have come via the talent schemes, the government, if not exceeded that target. The makeup, though, wasn't quite 50-50, to your point. The vast majority for
95% mainland.
Do you see the industry needing to do what you guys are doing, which is pivoting your portfolio companies, the F&B, catering to the mainland
When
Chinese?
you're in retail, you have to cater to who the customer is. And basically, that is the new customer, whether we like it or not. We're in a geopolitical world at the moment, and so many people, Hong Kong maybe doesn't have the reputation that we had in the past, which is wrong because Hong Kong is booming right now. But we're attracting, less tourists, international tourists, as we know, mainlanders, as we can see, are coming back again. But and many of the aside, if you asked me a week ago, before the Golden Week, I would have told you the mainlanders coming here were different. They weren't spending money. They're experiential tourists. They were taking pictures of their, of Lan Kwai Fong street sign every day. We get 200 of them.
It's Yvonne and I joke about this. I mean, where I live, which I think will go largely, we'll keep largely private. The crowds are just different. People are not buying their beer, but they're standing by the water taking a billion photos.
Exactly. And so it's changed. And so Hong Kong needs to change, whether it's the retail, because I'm doing 3 projects in China right now. I'm doing the Lan Kwai Fong because it's a very famous brand in China now. Doing one in Xi'an, one in Chongqing, and one in Sanya, Hainan, which is very, very good. And I asked the people in mainland, why aren't you coming to Hong Kong? Because what for? It's cheaper in China today because before COVID they took the luxury tax off.
Right.
And so and because of our high dollar. And so they think that it's better in China.
I was going to ask you about reports of the Hong Kong government lowering the liquor tax.
Yes.
Have you heard any conversations about this? Do you think it's enough to revive the nightlife here?
I don't know if it will revive the nightlife, but definitely it will be coming down. You'll see it in the policy address. I'm part of John Lee's advisory committee. I can't say much, but it will be coming down. How much remains to be seen. I was actually one of the ones helpfully responsible for the wine tax coming down to 0, and so I have a lot of experience with that because the income tax that the government gets on wine or spirits is very limited.
Yeah.
So why not? When we reduced the wine tax to 0, we became one of the wine capitals of the world. All the auctioneers are out here and all that. So why not do it now? Well, for the spirits, and so hopefully, that market. It will happen, and I don't know if it'll go to 0, but it'll be whatever it is. It'll be a reduction, and I'm not sure everybody will go out and grab a drink because of it, but I think that it'll help.
All right. Allan, it's great to have you as always here. Allan Zeman, their Lan Kwai Fong Group chairman, joining us here in our Hong Kong studios. We've got plenty more ahead. This is Bloomberg. All right, right, markets doing this here on this Monday morning. Yes, so momentum being lost, but then again, we're still talking about this rally being extended for another day here. Hang Seng is up about 0.8%. 8 shares still. You're still punching about 1% gains here this morning, and we're really, in the end, getting close to 23,000 for the Hang Seng as well. HS Tech still looking pretty strong. We're talking about those chip makers really kind of leading that charge here today. Alibaba also get an upgrade from Macquarie here for the stock as well. So certainly you're seeing big tech catching a pretty massive bid here this morning as well. We've got plenty more ahead. This is Bloomberg. .29 a.m. in Tokyo. Japanese markets are heading to that lunch break here, and really we continue to see that rally across the Japanese equities here, and that's really thanks to that weaker yen that we saw post blowout U.S. job support, right? So 148 levels we're talking about for dollar yen now. We're paring back on some of that yen weakness, but certainly you talk about where we're seeing when it comes to treasuries, right? That 2-year or the 4-year, 10-year, I should say, getting back to 4% levels for the first time since August. That's what's kind of driving that dollar yen trade here this morning, Dave.
Yeah, 150, right? And, well, I was in Japan. It was at 140. And lo and behold, we're back.
Poor you.
Yeah, I know. Markets across the region are doing their 0.7 and 1%. So you have, of course, the lift coming out of Japan. To some extent, Hong Kong, which was up a lot more at the open than it is right now. But then again, of course, that's what you get after the best 3 weeks in 50 years on the Hang Seng Index, right? So you do get some paring back, if you will. All roads, of course, lead to the briefing this time tomorrow out of the NDRC. You have the chairman, you have several of the vice chairs, of course, also joining that there will English translation. So that is in itself a message already too, that this is not just for a domestic audience, global investors. Hopefully you'll be tuning into that as well. In fact, on the NDRC and that upcoming briefing tomorrow, it was announced over the weekend calling for incremental measures to prop up the economy. We spoke earlier on with Vanguard, Chen Wang, the chief Asia-Pacific economist there at the group, about what she expects. Have a look.
But the second stage is really what they are going to do to revive the demand in the economy. And that is where I think all the eyes are actually on the fiscal policy, right? So I think, down the road, I mean, the NDRC press conference, as well as, probably later in October, what the National People's Congress, they are likely to approve more supplementary fiscal package, right? So that I think is going to be in the focus for the market to see what they can do to support the consumption as well as the overall economic growth.
Let's bring in Johanna Chua now, head of emerging market economics at Citigroup Global Markets. Johanna, I mean, the speculation is out there about how big this fiscal package is going to be. What's reasonable in your eyes for tomorrow?
Okay, so our house view is we're expecting $3 trillion. Okay. Now, I'm not sure if all of it will get announced already by tomorrow. So that $3 trillion includes $1 trillion additional to kind of help offset the revenue shortfall for the local governments in order to provide a bit more spending support. Another extra $1 trillion, which is maybe related to welfare and kind of consumption support. And then this extra $1 trillion that we have, the third $1 trillion, is more for bank recapitalization. There was an announcement, obviously, a couple of weeks back. Again, it's not clear whether that recapitalization will get announced in this particular press conference. But I think the ballpark we're thinking it has to be around the 2 to 3 trillion renminbi range. If it ends up being $1 trillion, we've been there before. Yeah. So from a quantum, it's got to be bigger. And then there also has to be, it's not just the quantum, but the composition. The composition has to have a little bit more consumption welfare support.
Yeah, I was going to ask you, how does that help the demand side of the equation?
Look, I mean, the challenges in China are very large. So anything, obviously, any little bit thing helps. Clearly, it helps anchor confidence. And the hope is that, there's just been so much precautionary savings behavior in households because of all this uncertainty. You just need a little bit more of a pivot in terms of expectation about what the government can do to help support you. And that might at least help change sentiment. I mean, look, I think it's too, it's not, we're going to change our GDP growth forecast this year. I mean, it's obviously it's already late in the year. And there's still a lot of challenges going into next year because who knows what will happen in the U.S. election. Who knows what will happen in a global manufacturing cycle? But at least it will help arrest the kind of vicious cycle of downward spiral of negative sentiment. So we think if it's around 2 to 3 trillion, it will help support the markets. Anything lower than that, there's obviously a risk of disappointment. But we think they've already been giving so many positive signals. It would be kind of counterproductive if they disappointed the markets at this point.
Yeah, I mean, what do you make of this rally in some ways, right? I mean, what separates this from being just like a dead cat bounce, which we've seen before in China, and something where we're starting to see, look, this is actually meaningful sort of structural change that we're seeing in the economy?
I think, okay, we've had at least 2 dead cat bounces this year. We had earlier this year when we had this national rescue fund to drive the stock market. But remember, back then, all the policy was still geared towards new productive forces, industrial policy. So there was no meaningful change. And then we had a mini dead cat bounce after the mid-May kind of property stimulus, which again ended up not being sufficiently big enough. I think this time, this is a bit different because I do think we really had like 3 days in a row of kind of waves of positive signals. Surprise, it's a bit departure from the usual policy support. We're getting more signal that they care more about consumption, welfare, and then obviously more signs of fiscal, especially with that unusual Politburo meeting we had on September 26th. And then you've got a central bank. I mean, it's not like PBOC is doing QE or zero rate at this point, but the fact that there's this bank recapitalization, the fact that they've done RRR rate cut at the same time, which is very unusual, plus liquidity support, plus forward guidance, it just seems like this is a bit of a departure. This seems like more meaningful than what we've seen in the 2 other dead cat bounces.
What triggered it, you think? Because you could say the first dead cat bounce was because of COVID reopening. They needed to open the borders and all that. What led to this change in mindset?
I think there's a number of things. I mean, clearly, economy was really continuing to, you look at all the data, and real economic data continue to show a lot of weakness, a lot of concerns about deflationary expectations sitting in. And I think one of the turnaround is it's now starting to obviously hit local governments, such that we're already seeing it's become very counterproductive that local governments are not raising enough revenue, so revenue is down, and therefore they're cutting back. Well, they're becoming more aggressive on non-tax collection, which is counterproductive to sentiment, and then they're cutting back on spending. So the fact that you're now having this kind of vicious spiral of austerity on the fiscal really makes things really a concern. And, I think from, again, look, the government, they have to care about social stability. They have to also care. I think you always hit this turning point when you kind of hit enough of a pain threshold that you got to do something. And I think that's, it's interesting. A lot of people thought that the Chinese government would wait until after U.S. election to see what happens before announcing anything. That's why expectation was so low this year, especially with the August, September was very weak. And that whole pivot in late September took people by surprise. And I just think, we had property, we had a couple of consecutive months of ongoing property weakness. It's weaker in August than it was even before, since this mid-May kind of property intervention. I think they realized they have to do something.
Yeah, Yvonne and I were talking about this too, and it seemed, that surprise briefing that kicked this all off was a PBOC briefing on that Monday. It was 9 a.m. That was after the Fed cut by 50, and maybe that was the window. Something you mentioned here as well. So 3 trillion, that seems to be the figure we need to work around for tomorrow. Take us from 3 trillion to something that you mentioned here, 10 trillion. 10% of GDP stimulus over the next 1 to 2 years. How do we get from point A to point B? And what does 10 trillion look like to you?
Sure. I mean, this figure is not final yet. These are the numbers that are circulating. Right now, 2 to 3 trillion is what we're waiting for at least for the coming this year until next year. I think, again, 10 trillion is over the course of a couple of years, right? And I'm really hoping that it's really not just the quantum, but the composition. That we get a more balanced approach of stimulus that is not just all supply-side infrastructure, industrial policy, but more to do with improving social welfare benefit system, maybe a personal income, consumer tax reform type of thing, something that will help consumers a little bit more. So that's what I'm looking for. Giving us a little bit of forward guidance over the next couple of years. I think that's important because, the property down cycle is still ongoing. That means that continues to have a drag on sentiment and demand. So you need to counteract that. And again, depending on how long, it's going to take a while for us to unwind this housing market down cycle. So the view is you need to give some forward guidance, at least to offset that, so that you prevent domestic demand from being too weak. So that's what we're expecting.
There's this prospect that you're getting China stimulus, the Fed's cutting now. It increases the likelihood that we might be heading to a no landing scenario. in the U.S. in some ways, and that jobs report certainly reinforced that in some ways. Do you think 50 basis points is out of the question here right now? And does one data point really change your whole macro view?
So right now, we don't think so. I mean, look, obviously, to be fair, the data was very good in terms of the non-farm, but there's still a lot of, if you look at broad-based trends, we still don't have a labor market that was as strong as before. We are still seeing kind of a trend weakness, although we got a little bit of a mini rebound recently. I mean, you look at some of the employment subcomponents of the PMI, they've all been quite weak. So again, there's very, very mixed signals at this point, but overall points to weakness. We don't have the same kind of fiscal impetus that we had in terms of households having a lot of excess cash balance. That's all been run down. So you're already seeing a little bit of fragmentation where low-income households are already struggling. So I still think it's just that there are other things that are kind of helping offset that. We still have accommodative financial conditions. We still have U.S. corporate balance sheets that are still quite strong. So you've got a little bit of mitigants.
Yeah.
But look, I mean, I see global manufacturing cycle in terms of PMI generally being weaker. I guess in U.S. is still relatively exceptional relative to obviously advanced economies. Look at Germany. But I still don't think it's that exceptional that it can completely defy the cycle.
Yeah.
So we are still thinking, look, the Fed has already pivoted to an easing cycle. We still expect an easing cycle. It's just that obviously they don't have to go that fast. And I think the big debate is still where do we end?
Yeah.
What is the terminal? And I think there is a risk market continues to reprice where that terminal is going to be.
Yeah, and as with other central banks, looking at that as well, I think we have three in the region this week: BOK, RBI, RBNZ.
Yeah, that's right.
Expectations for three.
So we have RBNZ and RBI on Wednesday. So RBNZ, we're expecting 50 basis points cut, which is now consensus. And we actually changed that. We used to have a 25 basis points. But New Zealand is in a different point of their economy. We actually think, even though the data was a little bit better than expected, they're coming from below potential growth. So their output gap is negative. So I think there's more push and a move for our pressure for RBNZ to accelerate its rate easing, and we expect them to cut actually 50 basis points back to back this year. So that's RBNZ. For RBI, India is a little bit different on Wednesday. So on Wednesday, we expect RBI is going to be on hold. I think the growth is still holding up in India, notwithstanding we had pretty benign inflation prints. I do think RBI is still going to wait until 2025 to cut because we've got kind of base effect going in the kind of unfavorable base effect, meaning that we could have CPI going up to around close to 5%. In the next couple of months. So we think they kind of wait, especially with oil prices surging now on the back of the Middle East tension. There's no urgency. There's just a risk that RBI could change its stance from being withdrawing accommodation to neutral. So we're looking for a potential change in stance. But again, that's not yet our base case, but that's something to watch out for. And then for Korea, we think BOK is going to cut on Friday, 25 basis points, their first cut. Because again, our 3.5% has been restrictive and domestic demand has been weak for a while. And now we're seeing a turn and a weakness in global manufacturing cycle. But I do think BOK, even if they cut 25, it will be a hawkish cut. Like they will cut and they will continue to signal that, again, they're not kind of cutting as much as the Fed. They're still going to cut very slow. So they're going to be very calibrated because, as you know, in Korea, they still worry about housing prices, financial stability. So I think that will create a little bit of constraint. They don't want market to overbet or over-speculate on too aggressive a cut. So they will try to lean against that with slower cuts.
I'm looking at the rest of the developed markets, though. I mean, the ECB seems like they're willing to cut more than the Fed at this point. Does that keep the dollar bid up a bit more into year end? And where do I see Treasury yields going? Is it 4%?
Yeah, look, I think at the moment the dollar could stay a little bit strong. I mean, obviously we've got we've got Middle East tensions that are still, we don't know how this is going to evolve. Not to mention we have, we're less than a month away now for elections. So there is a little bit of uncertainty. I mean, and like the US data is still holding up. So it's possible, yes, the dollar can still be bid up until, but again, I don't know, again, depending on what happens on the election outcome, and then if we get the whole weakness eventually fading, then there's bound for, again, the soft landing with the Fed easing should still be supportive of kind of a weak dollar eventually. In terms of Treasury, I mean, obviously we've already seen a big sell-off. Our rate strategist is thinking that actually, 10-year Treasuries could still have a little bit more pressure to kind of sell off, with 10-year yields. Maybe it could even go a little bit above 4, position unwind. But we don't really think it's going to go significantly beyond maybe 4.1 because the thinking is there's still a lot of uncertainties. We've got elections, so there'll be a cap in the yield. But that's where we are at the moment.
Johanna, thank you.
Thank you.
Let's see. 3 trillion. Keep that in mind. This time tomorrow, Johanna Chua, Head of Emerging Market Economics at Citigroup. Global Markets, if you're a Bloomberg client and subscriber, you can catch that interview in case you missed that and others that you might have missed. Our interactive TV function, TV Go, on your terminals. You can also join the conversation. A lot happening, of course, this time tomorrow. Catch that and more on TV Go. This is The China Show.
The Israelis have not concluded what they're going to do in terms of the strike. That's under discussion. I think if I were in their shoes, I'd be thinking about other alternatives than striking oil fields.
President Biden there speaking to reporters on Friday, and as Israel does mark a 1 year since the October 7th attacks by Hamas, it's locked into a multi-front war with no clear end. Prime Minister Benjamin Netanyahu is still weighing how to respond to Iran, which launched a salvo of almost 200 ballistic missiles at the Jewish state last week. Let's bring in our senior editor, Bill Ferry, is joining us from Singapore. So we're 1 year on, and still no signs of any sort of ceasefire, the like, Bill. What should we look for next in terms of milestones?
You're right, really no signs of tensions de-escalating in the region. Overnight, over the weekend, Israel launching fresh attacks in Gaza and northern Gaza, which had, basically been a little bit quieter in recent weeks as the focus had shifted toward northern Israel and Lebanon. But a big question in world capitals and in the markets is how Prime Minister Benjamin Netanyahu will decide to respond to those Iranian attacks and whether oil facilities will be a part of that. If you remember when Iran launched large-scale attacks on Israel back in April, the Israeli response was targeted but actually quite small. And the question is whether that was really a deterrent or not. Most analysts expecting a bigger Israeli attack, but in terms of the targets, that's just a source of a lot of speculation at the moment. But certainly people are expecting Netanyahu to follow through on his vow to retaliate.
And is it, Bill, I mean, it's all speculation at this point, but an educated guess would tell us that, would that be imminent, if at all here, Bill? Imminent, that's a kind of a vague term in some ways in terms of this conflict. I mean, certainly it's expected. The Israelis have not backed down when they've promised retaliatory acts. So I would expect it to happen now, whether that's today or this week. Certainly it seems like it's coming. I think Israel's going to look for the right targets, the right conditions to attack. Just a lot of speculation about whether those will be perhaps oil or nuclear facilities that Iran has built up. The markets, of course, very keyed in on that because Iran now producing more than 3 million barrels of oil per day, much of that going to China. So any disruption to that will have a big impact on market prices. Yeah, Bill, thanks for the clarification. Yeah, certainly imminent is a fairly vague term. I was maybe going more for, at some point we should be waiting for that. Bill, thank you so much. Bill Ferry's there in Singapore. Just getting us up to speed and what we know at this point in time. Plenty more ahead here on the China Show. We'll leave you with a look at equity markets about an hour 20 into the cash market session here in Hong Kong.
Chinese equities have been underpriced. We didn't time it, and we know that when markets open again tomorrow on the mainland, there's a possibility of a pullback, but our view is long-term. Now, in that context, the initiatives that come out tomorrow probably are continuing to support the consumer first, and then moving on to other industries as well.
At some point, the cycle turns. It's better if it happens quicker because of government action. But it would have happened anyway just because of the cycle. Some companies would have gone out of business, etc. So on a long-term basis, we think it's the right place to be. Of course, in the short term, it's very difficult to call. But we are significantly overweight China, and we expect to remain so.
All right, some of our guests there this morning, what to expect from mainland markets when they reopen tomorrow. And then the anticipation is palpable. It's growing in Chinese social media ahead of that market open. That topic, of course, is trending in China this morning. Yeah, let's bring in Min Lo, our China correspondent, taking us through really. Min, I mean, people should have been on holiday. They're cutting that short, looking ahead to the reopen, of course, tomorrow. They're really getting excited about what likely takes place in the opening minutes after the opening bell.
Yes, the hashtag China A-shares market reopens tomorrow. That's trending on Chinese social media. And remember, we previously reported that brokerages here in Hong Kong were seeing a massive jump in new accounts opening. I'm seeing on Chinese social media that there are many mainland Chinese who were traveling, especially to Hong Kong, to open up trading accounts during that Golden Week. Take a look at some of the quotes here. One social media user is saying, when a simple fact has become a trending topic on Weibo, you know how heated the market is. Take a look at some of the other quotes as well. It's still a day away and it's already trending on Weibo. What is the rush? Also, another one showing a little bit of skepticism here, saying, I hope A-shares can hang in there for 3 more days at least for me to believe in it. There's also a poll, by the way, on Chinese social media, Weibo, asking how much do you think the Chinese markets will rally tomorrow? And it seems like many people are very bullish. They're saying it's going to hit the daily limit as soon as the market reopens.
Oh, yeah. Just given just what we've been seeing in the Hong Kong market, right? Maybe that's not too big of an ask. What else are you seeing in terms of what people are saying on social media about this Golden Week holiday?
Yeah, well, my social media feed has just been filled with people taking photos of how crowded and packed all these holiday attractions are. And Huangshan is one iconic holiday site in Anhui province, just not too far away from Shanghai. And it's making its rounds on social media for these people sleeping in the toilets. Because apparently it was so packed that people couldn't get hotel bookings. They were all fully booked. And some of these people, they just wanted to be the first ones on the mountain to catch the sunrise. And they don't want to, just wait through that massive amount of people. And it was very cold in the mountains, so they ended up sleeping in the toilets where it was relatively warmer. So it looks like, anecdotally at least, that the consumers are coming out in full force this Golden Week holiday.
Yeah, clearly they don't mind the lack of room service. Min Min, thank you so much. Min Min Lo, our China correspondent, really getting us quickly out of the holidays and into this reopen tomorrow. And I guess just to give you a sense, Huangshan, that is really a hot spot. Beautiful place, by the way. Right. Going into the reopen tomorrow, so how much will this market rally at the open? There are imperfect proxies out there. One perhaps would be some of the A50 contracts. This is the one that traded over in Singapore. And while China was shut, it was up 16%. So do we get the same amount? We'll see. It's an imperfect analogy, of course.
And we were talking to Marvin Chen about what could actually lead to that sort of rally, right? Non-banking financials is probably where is the area in the pocket that you're going to see a lot of that catch up here. So the brokerages, for example, as Min Min mentioned, there's people from these brokerages, they're swarming the streets, they're trying to get people to open these stock market accounts ahead of this Golden Week holiday reopening, right? So definitely watch for that. You're seeing another day in terms of the Hong Kong market where these brokerages are doing very, very well. The likes of China Life Insurance, so insurers as well as one also area to watch for up some 6%. There as well. Citi had a pretty interesting call in the consumer sector, right? Consumption property certainly is one focus too.
Yeah, they upgraded some of these plays, of course, on the back of the policy boost. We were just speaking with Johanna, Chua, of course, which is a different team. She oversees the economics and rate side of the conversation here. So she put out a specific number to watch tomorrow. Anything roughly below that 3 trillion renminbi mark. So they've divided up 1 trillion, 1 trillion, 1 trillion in terms of bank recapitalization, some of the demand side spending. Anything below that might be seen as somewhat disappointing, but we'll see what the NDRC
And there has to be some sort of consumption tilt, right? For it to really have some impact, according to Johanna. You take a look at Macau casinos. They seem to be doing quite well here. We're watching some of these casino shares. So really it was on news of Wynn getting that gaming license from the UAE, which is a big, obviously, a milestone there. But certainly it could be the reopening story, too, that's lifting some of these stocks here this morning. Since China is up some 7%. HSI intraday is looking like this here right now. We're losing slight momentum, but don't say anything about that. This rally can't continue, right? We'll see how things go until tomorrow. That's it from us here on The China Show.